It's May 31st, 2022, and this is a video that takes 30,000 to a million. I'm going to take you through the account, and then after that, I want to talk a little bit about China, consumers, my thoughts as of late about the weighting that I'm giving the Chinese stocks in my account. So first is the account review. As always, I'll just do it really briefly. Let me move this. So I'm sitting at 178,600, which is a tiny bit more than I was over the weekend, mainly because of the after-hour action. So I was about flat coming in, but it's still nice to be green when the S&P 500 is red. So it feels good to kind of be ahead of the market a little bit. If you want to take a look at this SPY, that was down 0.56% and up 0.21 in the aftermarket. So it's good. If you want to see the 1 week performance, it's the count is up 14.65%. 1 month about flat, up 0.78, but still green. 3 months about flat, up 0.64, but still green, thankfully. And then there's the 1 year chart, 15.08, and the all-time chart, 147. But when I show the all-time chart, I always have to disclaim that I started investing in this account somewhere around here in 2018 and August 28th, 2018. So there wasn't any money in the account before that. So I have to keep that in mind. Okay, I'm going to go through positions on the right, starting with the options. You can find all the information you need about options in this box right here. I'm going to scroll down. You can pause the video player at any moment to try and find out the exact positions that I hold. You can sift through them and do the calculations yourself if you're interested. This is the equity position here. Apple was fairly flat. It was actually down, but in the aftermarket, it climbed up a little bit to almost a flat position. JD.com, Baba, and Vip Shops were up big in the beginning of the day, but they kind of trailed off. It's probably going to be a red day tomorrow, judging by today's action. So Realty Income was down a tiny bit, a little less than 1%. So was Main Street Capital. Goldman Sachs was about flat. Yeah, that's about it. I was looking to really catch some deals on Goldman Sachs today when it comes to put options, but I just didn't find any. I just didn't feel like they were a good deal at the moment. So we'll go to the wheel. Well, I guess I have to. It's making me log in again. It's weird. We'll go to the wheel. We'll go to sell put. And June 3rd, but I didn't see anything that was just worth tying up the capital. So I actually kind of left. I'm leaving the capital as it is. I'm not going to take out any money to get premium. So I just didn't think there was a good enough deal. I wanted to get the $320 puts here. Sell them. But 163 wasn't worth it. And 322.5 is a little too close to the strike price for me. So it looks like the premium, the implied volatility, has kind of tapered off a little, and I'm waiting for tomorrow for a down day in order to get back in. So for right now, I'm just going to chill and stay a little bit deleveraged. Speaking of being deleveraged, how we finished it? Yes, we are. Speaking of being deleveraged, check out this investing tab here. Market value only 219, and that's because the margin's only sitting at 40,000 now, 500 instead of like 135. You can see that it comprises 18.4% of the account. So I reduced the margin by like $100,000 in order to anticipate the next leg down. Now, I don't know if it's going to be a leg down. If it's not, then that's fine. I will continue to decrease margin into the bull run, and I do expect another 5-10% up. but there might be a short, like even a shorter term correction, like a 1 day or 2 day correction in the bear market rally, at which point I will try to snatch up some nice juicy contracts. But until that happens, I'm just going to stay put. In fact, I decreased the margin even a little bit more by getting rid of a few Chinese company options. Here is the count by total return. Looks like I got some more greens on the table here. Smith & Wesson brands turned green, which is, not surprising, I guess. This is the account sorted by equity. Apple right now sitting at by far the largest position, about 4 times more than Main Street Capital and Realty Income, which are the second and third largest positions. And VIP shops I'm going to get rid of hopefully soon. If you want to see how things stand on VIP shops, actually sold some positions, actually just straight up sold some shares. And this is my position now. I have 1,800 shares only, and I even have 2 calls sold at 9.5 and 2 calls at 10. So if those execute, I will be only left with 1,400 shares out of 30,000, 28,000 or something. So I made a conscious decision to try to reduce my Chinese exposure. Now, it is kind of at a low point. I did rally a little bit for me to kind of allow me to get out some of the shares, but you might be wondering why. And I think that my reasoning is that it's really hard to follow good data in China. It just became really exhausting to try to keep up with what's said, what's the direction. It looks like there's a lot of talking, but not actually a lot of action. And it looks like there's one side, some official says one thing, another official says another. There's a little bit of contradiction between the messaging and the actions that are being taken in China. So it's really hard for me to kind of read the landscape or have an idea of what the heck's going on. And in fact, because there's an action, it looks like the Chinese consumer is dipping further and further down. Now, I know that will eventually recover. They will bounce back. I think they're just probably scared a little bit of just very, very strict measures by the government, which I would be scared too, right? I would not be spending my extra cash or anything like that. I think they're probably experiencing something similar to what we had in March, April, June in 2020, where people were kind of locking down, especially some of the big cities that were affected by the lockdowns. And they're having issues. They're buying. There's this really interesting page I want to show you here. That is, it looks like I went up in the aftermarket even more. That shows some retail sales in China for the first 4 months of 2020. So there's a really big drop off in this chart here. You can see that it's in April, it's down 11% year over year. So it's a huge drop off in retail consuming. You can see it broken down by retail and food service revenue. But this chart is even more interesting. It tells you what people are spending money or not. I like this April chart here. It really highlights that things like garments, footwear, hats, knitwear, cosmetics, jewelry, okay, they're down 22, 26% year over year. So huge. So people are really pulling back on their extra spending, right? Material spending. I looked at some things that are up, and look at this one: traditional Chinese and Western medicine. Right? Look at this one: petroleum related products. So bare necessities, just bare necessities are up because people need them. Right? Beverages. People need to eat, drink. Even tobacco and liquor are down. You see that? It's just bare necessities only. Grain, You see this? Grain, oil, food up 10 year over year. Drinks up 6. Alcohol and tobacco down. Unnecessary. Clothes, cosmetics, jewelry, unnecessary, down. Right? Household appliances and AV equipment, down. Unnecessary, you can live. Traditional Chinese medicines and Western medicines, up. Necessary. Culture and office appliances, down. Furniture, down. Communication appliances, down. Automobile stuff, down 31%. 31.6% from year over year. So that's a huge decline, right? Mostly because people aren't able to go anywhere, but still, it's a very, very low decline. So if we assume that they're following the same trajectory, things will return eventually. But the thing is, China is not the US, right? They may not flood the system with money like we have. They may not have the same market rally like we did because of extra money, because everybody got some extra paychecks and stimulus cash and whatnot. The government may not and probably will not pad the accounts of the regular citizens. They'll just tell them, hey, look, we're going to lock you up. You go ahead and suffer through this, but you'll be fine on the other side. And so we may actually see how deep this depression kind of period lasts in China. And even though they are behind us a couple years when it comes to the crash, or a year and a half or so, they may actually give a really good study case of where we're going, right? If it wasn't for the artificial stimulations and all that happening in our economy. So I think it's a very interesting proxy for that. But even though I know it's going to rebound at some point, like, this data is kind of scary. I know I'm not changing my thesis on Chinese companies. I just think that it might take a little too long to do anything, and I don't really want to keep bleeding. And if things turn around today, and if we've seen the bottom, which I think we might have actually seen the bottom at Alibaba and so forth, I have plenty of leap contracts, right? Let me show you. Sorry. I have plenty of leap contracts. Like, I'm not out of China. Look at all these contracts on the right. Yeah, JD, 4 contracts for 2023. VIP shops, I have a few out of the money contracts here, a couple in the money. One, $25 one, out of the money. Alibaba, $140 calls, 3 of them. $110 call for 2024. $235 call just in case things get really crazy and heated up in there for 2024. And there's a JD call. I had 2, but I sold one of them today to raise some cash. So I have plenty of calls, and I still have 250 shares of JD, and then another which is worth about $14,000, and I still have 1,800, probably 1,400 if things continue to rise for the rest of the week in VIP shops. So that's another $15,000-$16,000. So it's still like 30K in there. It's not like I'm getting rid of the Chinese position, but I do want to reduce the leverage. Like, I don't feel good about being this leveraged, especially when we're staring at possibly another leg down, perhaps a big one, since liquidity doesn't seem to be coming back very strong, and the Federal Reserve is intentionally tightening financial conditions. They're looking for the stock market to drop. Like, they have that Fed call going on, and the Fed puts lower, like I discussed in a previous video, and they want things to go down. So, like, who am I to say, like, no, despite your best efforts, the market is going to keep going up? It might. And in fact, there's going to be, I think, some kind of shift here, because the US dollar has been getting really strong, and inflation has been rising, which is very, very contradictory, and it has to be short term. So the market is going to get bid up somewhere. We just don't know where. These dollars all need a home, and they might find a home in bonds or savings accounts or whatever, but some of it's going to go into stocks, and it looks like it's going in oil, defensive stocks. Well, let's take a look at the map. Amazon had a nice day. Everything else kind of red. Let's look at the last 3 months. So you can't really see it on the right. You can kind of barely see it, but that's energy sector, the green one. So it's been going in utilities, which is very defensive. It's going in energy. It's going in big pharma and insurance. Like, that's kind of the only things that money's going into. Maybe some in AT&T. Everything else has been drawing down, especially big tech. So that's kind of like the way money has been shifting. If it wasn't shifting, the drops would be a lot bigger, right? Because we have some of the market leaders that have been just getting their heads cut off. Let's take a look at the 6 months performance here. See, the Amazon's down 32.5%, Tesla's down 33%, Google 21%, Nvidia 44% down. I mean, these are big market movers, right? And the indexes would probably be down a lot further than that. So there has been some shifting. Just there's a lot of dollars in the market still. It just hasn't really found a home. And things will start getting interesting when it does start to find a home. I'm not necessarily looking for real market appreciation, but more so a nominal one. All right, I've been rambling on, I think, long enough. That's the account update. What else? I've been doing account reviews, so if you want company reviews. So if you want me to give my quick opinion on a company, maybe a holding of yours or something that you're looking at, I could perhaps add some perspective on that company. So give me the ticker symbol below in the comments, and I'll make a video about it. All right, peace out.